This one number decides. If debt makes you rich or poor, most people think they understand debt. Credit card debt is bad. Mortgage debt is good. Student loans are complicated. Car loans are normal. And if you just put every loan into the right category, you will be fine. But that is exactly where people get trapped. Because debt is not good or bad because of what you bought. Debt is good or bad because of one number, the interest rate. More specifically, the interest rate compared to what your money could earn somewhere else. That comparison decides everything. It decides whether debt is quietly building your wealth or quietly draining it. And most people have never calculated it for even one of their loans. They just make payments, month after month, year after year, feeling responsible because they never miss a due date. But here's the uncomfortable truth: you can make every payment on time and still be getting poorer. Because paying on time is not the same as winning. It only means you are following the rules of a game you may not understand. Let's make this simple. Debt means someone gives you money now, and you promise to pay it back later with interest. That is it. A credit card, a mortgage, a car loan, a student loan, a personal loan, they all work the same way. Money now, money back later, plus a fee. That fee is the interest rate. The problem is that most people focus on the story around the debt. A mortgage feels responsible because it buys a house. A car loan feels normal because everyone needs transportation. A credit card feels bad because it buys small things that disappear. But the story is not what matters most. The math does. A mortgage at 3% and a credit card at 24% are not different because one is attached to a house and one is attached to shopping. They are different because one rate is low and one rate is financial poison. The object you bought is emotional. The interest rate is mathematical, and math is what builds or destroys wealth. Here is the rule: if your debt costs more than your money can realistically earn elsewhere, pay off the debt. If your debt costs less than your money can realistically earn elsewhere, it may make sense to invest instead. That is the line. Everything above the line attacks your wealth. Everything below the line may help your wealth. Let's say you have a credit card charging 24%. Every dollar you leave on that card is working against you at 24% per year. Now ask yourself, can you reliably invest money somewhere and earn more than 24% per year after taxes with low risk? Almost certainly not. So paying off that debt is not just paying a bill. It is like earning a guaranteed 24% return. No stock market risk, no guesswork, no taxes, just pure financial improvement. That is why high interest debt is so dangerous. It is not just annoying. It is one of the most powerful wealth destroying machines in ordinary life. Now let's look at two people. The first person is Jake. Jake thinks he is responsible with money. He has a job. He pays his bills on time. He checks his budget. He never misses a minimum payment. But Jake carries $8,000 on a credit card at 24%. To him, it feels manageable. It has been there so long that it almost feels like a normal bill. Every month he pays a few $100s. The balance moves down slowly. Then something happens: a car repair, a birthday, a trip, a few bad weeks of spending, and the balance goes back up again. Jake does not feel like he is in a crisis, but mathematically he is. At 24%, that $8,000 costs him almost $2,000 a year in interest. That is money leaving his life and buying him nothing. No asset, no freedom, no future income. Just the privilege of keeping old debt alive. Jake is not irresponsible. That is the scary part. He is disciplined enough to make payments, but he has not realized that the bank is earning a better return from him than he will probably ever earn from the stock market. Jake thinks he is managing debt, but really, the debt is managing him. Now meet Daniel. Daniel also has debt. He has a mortgage. The balance is large, much larger than Jake's credit card. But Daniel's mortgage has a fixed rate of 4%. Some people would look at the balance and panic. They would say, debt is bad, pay it off as fast as possible. But Daniel understands the line. His mortgage costs 4%. If he has extra money, he has a choice. He can pay down a 4% mortgage, or he can invest in a diversified portfolio that may earn more over the long run. Paying off the mortgage gives him a guaranteed 4% return. Investing may give him more, but with risk. This is a real decision. It is not obvious. It depends on his risk tolerance, job stability, taxes, and emotional comfort. But here's the difference between Daniel and Jake. Daniel's debt is not eating him alive. Jake's is. Daniel's debt is cheap enough to compare against investing. Jake's debt is so expensive that there is almost no comparison. That is why good debt and bad debt are too simple. A mortgage can be dangerous if the rate is high and the payment destroys your cash flow. A credit card can be harmless if you pay it off every month and never pay interest. The category does not decide, the rate decides. This is where most personal finance advice becomes too shallow. It tells you credit cards bad, mortgages good, student loans maybe, car loans normal. But the real question is, what is the interest rate? A 28% credit card balance is an emergency. A 15% personal loan is a serious problem. A 9% car loan is not harmless. A 6% student loan is a judgment call. A 3% fixed mortgage may be worth keeping while you invest. Same concept, different numbers, different decisions. The debt line is not emotional. It is not based on whether your parents approve. It is not based on whether your friends have the same loan. It is based on this. Is this debt costing me more than my money could reasonably earn somewhere else? If yes, destroy the debt. If no, consider whether investing makes more sense. That one question can save you years. Now here's the part that changes how you see debt. Paying off high-interest debt is often the best investment available to you. Imagine someone tells you, I have an investment that gives you a guaranteed 24% return, tax-free with no market risk. You would think it is a scam. But if you have a credit card charging 24%, that opportunity is real. It is sitting in your own financial life. Every dollar you use to pay off that card stops a guaranteed 24% loss. That is not boring. That is powerful. The problem is that paying off debt does not feel like investing. It does not give you a shiny portfolio chart. It does not make you feel sophisticated. It does not sound exciting at dinner. But financially, it may be one of the smartest things you ever do. Because sometimes the path to wealth is not finding a better investment. Sometimes it is removing the thing that is quietly destroying your returns. And this is also why rich people use debt differently. You may have heard that wealthy people use debt to get richer. That is true in some cases. But not because debt is magical. They use debt when the math works. They borrow at a low rate against assets that may grow at a higher rate. For example, if someone owns a large stock portfolio or real estate, they may borrow against it instead of selling it. Why? Because selling may trigger taxes. Borrowing may allow the asset to keep growing. If the borrowing cost is low and the asset grows faster, the spread works in their favor. That is the same principle. Borrow cheap, earn more. But here's the danger. Many ordinary people hear rich people use debt and misunderstand the lesson. They think debt makes people rich. No. Debt amplifies the direction you are already moving. If the math is good, debt can accelerate wealth. If the math is bad, debt accelerates poverty. A low interest loan used wisely can be a tool. A high interest balance used emotionally can become a trap. The rich are not using a different law of money. They are just standing on the right side of the line. So, what should you actually do? Start by making a list of every debt you have: credit cards, car loans, student loans, personal loans, buy now, pay later, mortgage, anything. Next to each one, write down the interest rate, not the monthly payment, not the balance first, the rate. Because the rate tells you how dangerous the debt is. Then rank them from highest rate to lowest rate. The highest interest debt goes first. Usually that means credit cards, then personal loans, then expensive car loans, then maybe student loans, then lower rate mortgages. The exact order depends on your situation, but the principle is simple. Attack the debts that are charging you the most, because those are the ones producing the highest guaranteed return when you eliminate them. There is one important exception. If your employer offers a retirement match, that can be an instant return that is too good to ignore. For example, if your employer matches part of your contribution, that match may be worth taking before extra debt payments, depending on the details. But after that, the interest rate usually decides the order. High rate debt first, low rate debt later. Investing alongside low rate debt can make sense. Investing while carrying toxic debt usually does not. Let's make it practical. If you have a credit card at 24%, that is not a casual debt. That is a fire. If you have a personal loan at 14%, that is still above what most investments can reliably beat. If you have a car loan at 9%, that deserves serious attention. If you have a student loan around 6% or 7%, now you are in a gray area. Paying it down gives you a guaranteed return. Investing may do better over time, but not guaranteed. If you have a fixed mortgage at 3% or 4%, aggressively paying it down may not always be the best mathematical choice. For some people, it still feels emotionally right, and that matters too. But it is not automatically the best wealth building move. The point is not to create one rule for everyone. The point is to stop guessing. Because debt decisions should not be based on vibes. They should be based on rates, risk, and alternatives. There is another side to this rule. It does not only apply to debt, it applies to cash too. If your money sits in a bank account earning almost nothing, while another safe account pays much more, that is also a rate problem. Same money, same safety, different result. A person who ignores rates loses quietly. A person who checks rates wins quietly. This is why financially strong people are not always doing complicated things. Sometimes they are just paying attention to small percentages that everyone else ignores. A few percent here, a few percent there. Less interest paid, more interest earned, lower fees, better decisions. Over decades, these small gaps become huge. Wealth is often built in the spread between what you pay and what you earn. So here is the real lesson. Debt is not the enemy. Ignorance is. Debt is a tool. But every tool can hurt you if you do not understand how it works. A hammer can build a house. It can also break your hand. Debt can help you buy an asset, start a business, or keep growing your money while borrowing cheaply. But debt can also drain your future through high interest, minimum payments, and emotional spending. The difference is not the label. The difference is the math. So stop asking, is this good debt or bad debt? Start asking, what is the rate? What else could my money earn? Is this debt working for me or against me? Am I borrowing cheap and earning more? Or am I borrowing expensive and pretending it is normal? That is the question that changes everything. Most people do not stay poor because they have debt. They stay poor because they do not know what their debt is really costing them. They see the payment, but not the drag. They see the balance, but not the interest machine behind it. They see the monthly minimum, but not the years being taken from their future. Once you understand the rate, the fog clears. You know which debts to destroy, which debts to manage, which debts may be worth keeping. And when investing actually makes sense, that is when debt stops being confusing. It becomes a lever. Pointed one way, it pulls you backward. Pointed the other way, it can help move you forward. The rich did not get a different tool. They just learned which way to point it. And now, so can you.